You ever notice something strange about money? You work harder every year, but somehow things keep getting more expensive. Savings shrink, prices rise, markets crash, and nobody really explains why. You're told it's inflation. You're told it's the economy. You're told it's complicated. But here's the uncomfortable truth most people never hear. Some of the biggest economic disasters in history weren't accidents. They were the result of decisions about money. Decisions made quietly, inside institutions most people never question. In this video, we're going to explore the powerful ideas behind A Monetary History of the United States by Milton Friedman and Schwartz, a book that changed how economists understand money, crises, and the Great Depression. But this won't be a dry economics lecture. You'll discover why economic crashes spread like psychological contagion, how central banks gained power over the modern economy, the hidden reason the Great Depression became so catastrophic, why inflation slowly erodes wealth without most people noticing, and how understanding money can protect you from the same cycles that trap millions. Because once you see how the system actually works, you stop reacting like the crowd, and you start thinking differently about money, power, and stability. So if you've ever wondered why the economy feels unpredictable, and why your financial future often feels out of your control, stay with me. By the end of this video, you won't just understand economic history. You'll understand the psychology behind it. Chapter 1. You think money is neutral? Look again. Have you ever asked yourself a quiet, uncomfortable question? Why does an entire nation sometimes behave like a panicked crowd? You think people make markets, but sometimes markets make people. This is where the story begins. Two economists, Milton Friedman and Schwartz, one a relentless defender of free markets, the other a historian who understood that numbers alone cannot explain human behavior. In 1963, they wrote A Monetary History of the United States, 1867 to 1960. Not a normal economics book, more like an autopsy. They studied nearly a century of American money, banking, crises, inflation, depression, and what they discovered was unsettling. Their core claim was simple, almost brutal. Economic disasters are rarely accidents. They are often created by the way money is controlled. Governments believed they were stabilizing the economy. But Friedman and Schwartz showed something darker. When the supply of money shrinks too fast, when banks collapse, when central authorities hesitate, the entire economy suffocates, like a body starved of oxygen. Their most controversial argument was about the Great Depression. For decades, people believed capitalism failed. Friedman and Schwartz disagreed. They wrote that the Federal Reserve allowed the money supply to collapse between 1929 and 1933. Banks failed. Credit vanished. Fear spread. What followed was not just recession. It was economic paralysis. This might sound technical, but it reveals something psychological. Humans do not react to reality. They react to liquidity. Money is trust in motion. When trust freezes, civilization slows. A study by psychologist Daniel Kahneman in 1979 discovered loss aversion. People fear losses more than they value gains. Now imagine that instinct multiplied across millions of people during a financial panic. Everyone withdraws, everyone hoards, and suddenly the system collapses under its own fear. Marcus Aurelius once wrote that people suffer more in imagination than in reality. Economies are no different. Fear spreads faster than facts. Friedman and Schwartz were not just writing about money. They were writing about power, because whoever controls the supply of money quietly influences the behavior of millions. This might sound unsettling, but understanding it is the first step toward seeing the system clearly. And clarity, as the Stoics insisted, is the beginning of freedom. Next, the story gets darker, because once you understand money, you start to see how fragile stability really is. Chapter 2. You trust banks too easily, but history doesn't. Let me ask you something you rarely pause to consider. When you deposit money in a bank, do you really believe it is waiting there for you? Or do you just trust the story? Pause on that. Because the early chapters of a monetary history of the United States reveal something unsettling about the American financial system after the Civil War. Friedman and Schwartz wrote that the system was not built on stability. It was built on improvisation. Between 1867 and the early 1900s, America lived under what was called the national banking system. It sounded organized. It wasn't. Banks were required to hold government bonds to issue currency. In theory, this created discipline. In reality, it created rigidity. Money supply could not easily expand when people needed it most. So what happened? Every harvest season, farmers needed cash. Businesses needed credit. But currency was limited. Pressure built quietly, like steam inside a sealed pipe. Then came banking panics. Each panic followed the same psychological pattern. Rumor spreads. Depositors rush to banks. Banks run out of cash. Fear becomes prophecy. Even healthy banks collapse when everyone withdraws at once. Friedman and Schwartz wrote that these crises were not random storms. They were the result of a system that could not flex under pressure. Sun Tzu once said that rigidity invites defeat. Systems survive through adaptability. Finance obeys the same law. A psychological study by Robert Shiller in 2000 later described something called narrative contagion. Economic stories spread like viruses. When enough people believe collapse is coming, they behave in ways that create it. Fear becomes infrastructure. This might sound harsh, but it is necessary to say it clearly. Banks do not fail only because of bad assets. They fail because trust disappears faster than institutions can respond. And trust is fragile. Think of a dam holding back water. As long as everyone believes the wall will hold, calm remains. But the moment people suspect cracks, panic moves faster than reason. That is what Friedman and Schwartz began documenting in these early chapters. America was not learning from each crisis. It was repeating them. And with each panic, a quiet question grew louder in the background. Should someone control the system? Or would that power create something even more dangerous? Because once authority enters the room, money stops being just money. It becomes strategy. Chapter 3. You think central banks bring stability? Look closer. Let me ask you something uncomfortable. When chaos appears in a system, do you solve it with discipline? Or do you create a bigger authority to control it? America faced that exact question after the panic of 1907. Banks collapsing, depositors panicking, markets freezing, and strangely, the man who stabilized the system was not the government. It was a private banker. J.P. Morgan gathered bankers in a room and forced them to rescue failing institutions. Friedman and Schwartz referenced this episode as proof that the financial system lacked a true lender of last resort, someone who could inject liquidity when fear choked the market. But here is the deeper psychological layer. When people feel unsafe, they demand a guardian, even if that guardian eventually becomes powerful enough to reshape the entire game. So in 1913, the United States created the Federal Reserve System. The mission sounded noble: stabilize banks, provide elastic currency, prevent financial panics. In theory, this new institution would act like the nervous system of the economy, sensing stress and responding quickly. But systems designed to control chaos often carry their own risks. Friedman and Schwartz wrote that the Federal Reserve inherited enormous influence over the money supply. For the first time in American history, a centralized body could expand or contract liquidity across the entire nation. That power is subtle. It doesn't feel dramatic, but it shapes everything: interest rates, credit expansion, market optimism, and more importantly, human behavior. A psychological study by Stanley Milgram in 1963 discovered something disturbing about human nature. People often trust authority even when the authority may be wrong. The same instinct appears in financial systems. When a central institution exists, markets begin to assume it will always intervene. Risk quietly grows under that assumption. Seneca once warned that dependence weakens judgment. The same principle applies here. Central banks promise stability, but they also create expectations, and expectations reshape incentives. This might sound controversial, but it must be said clearly. When power centralizes around money, mistakes become larger, because the system becomes more interconnected. One wrong decision can ripple across the entire economy. Friedman and Schwartz were not condemning the Federal Reserve outright. They were doing something more dangerous. They were documenting its consequences, calmly, methodically, because the next chapter of history would reveal something that shocked even them. A mistake so profound, it helped turn a recession into the Great Depression. And once you understand that story, you begin to see how fragile economic confidence truly is. Chapter 4. You think the Great Depression was inevitable? That's the lie history taught you. Let me ask you something directly. When a civilization collapses economically, do you think it just happens? Like weather? Or do you suspect someone, somewhere, made decisions that quietly lit the fuse? Milton Friedman and Schwartz looked at the Great Depression and refused to accept the easy story. For decades, the world believed one thing: capitalism collapsed in 1929. But when they examined the numbers, month by month, bank by bank, year by year, a different picture emerged. Between 1929 and 1933, the United States lost nearly 1/3 of its money supply. Not spending, not production, money itself. Banks failed across the country. Depositors rushed to withdraw their savings. But the Federal Reserve, the very institution designed to prevent panic, stood mostly still. Friedman and Schwartz wrote that instead of flooding the system with liquidity, the Fed allowed thousands of banks to disappear. Credit evaporated. Businesses suffocated. People lost jobs, homes, and dignity. The crisis became catastrophic not because the market fell, but because the financial system was allowed to collapse underneath it. This is a brutal lesson about systems. A body can survive injury, but not suffocation. A psychological insight helps explain why authorities froze. Studies on group decision paralysis by Irving Janis in 1972 discovered that powerful institutions sometimes fall into what he called groupthink. Members avoid conflict. They hesitate. They delay action because uncertainty feels dangerous. Ironically, hesitation becomes the real disaster. Marcus Aurelius wrote that delay often strengthens the very problem we fear. History proves it. The Fed had tools. It could have expanded the money supply, could have supported banks, could have restored confidence. Instead, the system tightened, fear multiplied, and the depression deepened. This might sound harsh, but it must be said clearly. Economic catastrophes are often amplified by human hesitation. Not evil, not conspiracy, just fear inside institutions. Friedman and Schwartz didn't write this with anger. They wrote it like surgeons, precise, because once you accept this truth, another question emerges. If the Great Depression was made worse by monetary failure, then what happens when societies start believing government control is the only solution? That question shaped the next era of American economics, and it changed the balance between freedom and intervention for generations. Chapter 5. You believe governments fixed the crisis? Look at what they actually changed. Let me ask you something that most history books quietly skip. When a disaster shakes a nation, do leaders fix the system, or do they rebuild power around it? After the Great Depression devastated America, something deeper shifted. People were not just afraid of poverty anymore. They were afraid of instability itself. Fear changes the psychology of a society. When uncertainty grows large enough, people willingly trade freedom for security. Friedman and Schwartz described how the 1930s became a turning point. The government stepped into areas that markets once handled alone. Banking reforms, deposit insurance, financial regulation, centralized oversight. On the surface, these policies looked like protection. And in some ways, they were. The creation of FDIC insurance in 1933 restored trust in banks because depositors no longer feared losing everything overnight. Trust returned. But Friedman quietly warned about something deeper. Policies created to solve yesterday's crisis often shape tomorrow's incentives. Once deposits were insured, Banks faced a subtle psychological shift. If losses are partially protected, risk can quietly increase. Economists later called this moral hazard. A study by Kenneth Arrow in 1963 explained this phenomenon clearly. When people are shielded from consequences, their behavior changes. Not always consciously, but inevitably. Think about a soldier wearing armor. Protection allows courage, but it can also invite recklessness. Systems behave the same way. This does not mean reforms were wrong. Many stabilized the financial system for decades. But Friedman and Schwartz argued that the deeper lesson of the Depression was misunderstood. People believed government action saved the economy. Friedman believed something else. He believed the economy would have recovered earlier if monetary collapse had been prevented in the first place. In other words, the solution was not more control after the disaster. The solution was competent monetary management before the disaster. That difference matters, because once institutions grow larger, their mistakes grow larger too. Nietzsche once suggested that systems built to protect life can sometimes suffocate it. Economics is not immune to this paradox. The reforms of the 1930s created stability, but they also created a world where the state became deeply intertwined with money itself. And once governments learn they can influence the economy through monetary policy, they rarely stop, which leads to the next chapter of this story. Because when power over money expands, temptation quietly follows. The video is half finished. If you like the video, be sure to comment and watch the next steps. Chapter 6. You think inflation is an accident? It's often a decision. Let me ask you something most people never question. When prices rise, when your money buys less each year, do you think it just happens? Or do you suspect someone somewhere opened the floodgates? Friedman and Schwartz spent long sections of their work studying inflationary periods in American history, especially during wars and political pressure. What they found was painfully simple. Inflation rarely appears from nowhere. It usually follows expansion of the money supply. When governments need resources fast, wars, crises, political promises, printing money becomes the easiest path. Not the wisest, just the easiest. During World War I and later during World War II, the United States dramatically expanded the money supply to finance spending. Friedman and Schwartz showed that when money grows faster than production, prices eventually rise. It may take months, sometimes years, but the pressure always surfaces. Think of it like pouring water into a closed container. At first, nothing looks different. Then suddenly the lid begins to shake. This is why Friedman later said a sentence that became famous in economics. Inflation is always and everywhere a monetary phenomenon. Not a mystery, not fate, a consequence. Psychology explains why societies tolerate it for so long. Studies on temporal discounting by George Ainsley in 1975 found that humans prefer short-term rewards over long-term stability. Governments behave the same way. Printing money today solves problems today. The consequences arrive later, usually after elections. This might sound cynical, but understanding incentives makes the system clearer. Seneca warned that prosperity often hides slow decay. Inflation behaves the same way. It does not explode immediately like a crisis. It erodes quietly. Savings shrink. Wages chase prices. Confidence weakens. And many people don't notice until years have passed. This is why inflation is sometimes called a hidden tax. No announcement, no vote, just gradual loss of purchasing power. Friedman and Schwartz were not arguing that money expansion should never happen. Economies sometimes need flexibility. Their warning was simpler. When political pressure controls the money supply, stability becomes fragile. Because power and temptation rarely stay apart for long. And when that temptation grows, another force enters the story, one that even powerful economists struggle to control: human optimism. Chapter 7. You think booms mean strength? Sometimes they're just the calm before collapse. Let me ask you something honestly. When the economy feels strong, markets rising, credit flowing, everyone confident, do you slow down and question it? Or do you lean in, just like everyone else? Because history shows a quiet pattern most people ignore. The same optimism that builds prosperity can also plant the seeds of collapse. Friedman and Schwartz noticed something subtle in several economic expansions throughout American history. Periods of rapid growth often came with easy credit and expanding money supply. Banks lend more. Businesses invest aggressively. Consumers spend with confidence. For a while, it feels like progress. But under the surface, something psychological begins to shift. Risk starts to feel normal. A study by economist Hyman Minsky in 1975 described this pattern clearly. Stability itself creates complacency. When systems operate smoothly for long periods, people begin believing the good times will continue indefinitely. Debt increases. Speculation grows. Caution fades. Minsky called this the financial instability hypothesis. It's not dramatic at first, just small decisions stacking up. A company borrows more than usual. Investors chase faster profits. Banks loosen standards slightly. Each step feels harmless. But collectively, the system becomes fragile. Sun Tzu warned that the moment armies feel invincible is often when defeat approaches. Markets obey the same psychology. Friedman believed monetary policy could either moderate these cycles or quietly amplify them. If money expands too quickly during a boom, optimism becomes fuel. Not just for growth, for excess. And excess is dangerous because it hides inside success. Think of a forest growing thicker every year. Trees everywhere, dense, strong, beautiful, until a spark appears. Then suddenly the same density that created strength becomes the reason the fire spreads so fast. Financial systems work the same way. Confidence accumulates, leverage increases, and the system becomes vulnerable to shock. This is the paradox of prosperity. The better things appear, the less people prepare for danger. Marcus Aurelius wrote that fortune often blinds those who rely on it too heavily. Economies are no different, which leads to a darker realization in the next chapter. Because when the system finally cracks, the panic that follows can reshape the entire structure of power again. Chapter 8. You think panic is irrational? It's actually human nature. Let me ask you something uncomfortable. If tomorrow people believed banks might fail, would you calmly wait and observe? Or would you rush to protect yourself first? Be honest. Because this is where financial systems collide with human psychology. Friedman and Schwartz spent significant attention on banking panics, those moments when trust vanishes faster than institutions can respond. And their analysis reveals something unsettling. Panics are rarely logical, but they are deeply human. When one person withdraws money, nothing happens. When thousands do it at once, the system fractures. Even healthy banks cannot survive a full withdrawal wave because banks lend most deposits to businesses and borrowers. The money exists inside the economy, not inside vaults. This structure is called fractional reserve banking. It works well during stability, but under fear it becomes fragile. Imagine a stadium where someone whispers that the exit doors may close. The whisper spreads. Suddenly everyone runs. The doors themselves did not change, but perception did. Psychologist Gustave Le Bon observed this behavior in the crowd, 1895. He wrote that individuals inside a crowd begin thinking less like individuals and more like a single emotional organism. Fear becomes contagious. In finance, this contagion is devastating. Friedman and Schwartz showed that during the early 1930s, waves of bank failures created exactly this chain reaction. One collapse triggered rumors. Rumors triggered withdrawals. Withdrawals triggered more collapses. The cycle fed itself. This might sound harsh, but it must be said directly. Markets are not purely rational systems. They are emotional systems with numbers attached. And emotions move faster than policy. Seneca once observed that fear spreads quicker than reason because it speaks directly to survival. The same instinct governs financial behavior. When people sense danger, they do not wait for data. They act. That action can save individuals, but it can destroy systems. Friedman's deeper point was simple but powerful. When monetary authorities fail to respond quickly during panic, fear compounds into catastrophe. Liquidity must appear faster than fear spreads. If it does not, trust disappears. And once trust disappears, rebuilding it becomes painfully slow. But the story does not end with panic. Because after every collapse, something else quietly follows. Control. Chapter 9. You think control solves chaos? It usually creates a new one. Let me ask you something you probably felt before but never said out loud. When systems break, when panic spreads, when people demand protection, why does the answer almost always become more control? After the financial collapses and instability of earlier decades, governments and central banks gradually increased their influence over money, credit, and banking rules. Friedman and Schwartz observed this transition carefully across the mid-20th century. And here is the quiet shift most people missed. Money stopped being just a medium of exchange. It became a policy instrument. Interest rates could now guide investment. Money supply could influence employment. Central banks became the unseen hands steering economic rhythm. On paper, this looked wise. But power over money comes with a psychological trap. Once authorities believe they can manage the economy, they start believing they should. A study by Philip Tetlock in 2005 on expert prediction found something humbling. Even highly trained experts often fail to forecast complex systems accurately. Economies, like weather, contain too many moving parts. Yet institutions still try. Not because they are foolish, because they feel responsible. Here lies the tension Friedman emphasized. The more centralized the system becomes, the more every decision matters. A small policy shift can ripple through millions of lives. Credit expands. Markets react. Businesses hire or hesitate. The consequences spread far beyond the original decision. Machiavelli once wrote that rulers who try to control fortune too tightly often provoke the very chaos they seek to avoid. Economic policy follows the same paradox. Control can stabilize, but it can also distort signals. Prices, interest rates, and investment decisions begin reflecting policy expectations rather than pure market behavior. When that happens, economies stop listening to reality and start listening to authority. And authority, no matter how intelligent, is never perfect. Friedman's concern was not about conspiracy or corruption. It was about scale. When influence over money becomes large enough, mistakes become systemic. Not local, not temporary, systemic, which leads to the final lesson of this long historical journey. Because if money shapes behavior, and behavior shapes society, then understanding money is not just economics. It is self-defense. Chapter 10. You think money is just economics? It's actually power over human behavior. Let me ask you something quietly personal. When you think about money, do you see numbers? Or do you see the invisible force shaping your choices every day? Milton Friedman and Anna Schwartz did not just write a book about financial statistics. What they built was something deeper. A long map showing how money quietly guides the behavior of entire societies. Through every chapter of American history they studied, one pattern kept appearing. Money expands, confidence grows, risk increases, then money contracts, fear spreads, people retreat, economies freeze. It looks mechanical, but it is deeply human, because money is not merely paper, credit, or digital balance. It is stored trust, and trust determines action. A psychological insight from economist George Akerlof in 2009 described something called animal spirits, the emotional instincts that drive economic decisions. Confidence pushes people to invest, hire, and innovate. Fear pushes them to hoard, delay, and withdraw. The economy moves with these emotional tides. Friedman's final argument was strikingly calm but powerful. He believed the best monetary system is not one that constantly manipulates outcomes, but one that provides predictability. Stable growth of the money supply, clear rules, minimal surprise. Why? Because humans function better when uncertainty is limited. Seneca once wrote that a wise system removes unnecessary chaos so people can focus on living well. Economics follows the same principle. When money behaves unpredictably, individuals cannot plan. When it behaves consistently, societies become more resilient. This might sound simple, but simplicity is often the hardest discipline. Governments are tempted to intervene. Markets are tempted to speculate. Institutions are tempted to prove their influence. But Friedman's message remained steady. Control the growth of money carefully. Avoid sudden contraction. Avoid reckless expansion. Respect the psychology of trust. Because when money destabilizes, it does not just damage markets. It reshapes lives. Careers vanish. Families suffer. Nations change direction. Understanding this history is not about predicting the next crisis. It is about seeing the system clearly. And clarity gives you something rare. Not control over the economy, but awareness of the forces shaping your world. The Stoics believed that freedom begins when you understand the structure of reality instead of blindly reacting to it. Money is part of that structure, quiet, powerful, and always moving beneath the surface of human behavior. Thank you very much for watching my video, and please like and subscribe to my channel.